The biggest financial mistake my friend Marcus ever made wasn't the one that left him broke at 26. It was the one at 41, when he was finally doing well. The first mistake was textbook young person stuff. 21% interest on 3 different credit cards. A leased BMW he couldn't actually afford. 4 years of skipped 401k contributions because he was waiting until things stabilized. He paid for that combination with 5 years of being broke, anxious, and stuck in a roommate situation he hated. But that mistake was survivable because at 26, he didn't have much to lose. The second mistake almost cost him his entire net worth. By 41, Marcus had $480,000 in a portfolio, a paid down mortgage, and a 6-figure income. He had finally built something. And the trap that caught him at 41 didn't even exist when he was 26. It only shows up after you've built something worth losing. That's the part most personal finance content gets wrong. The traps don't stay the same as your net worth grows. They change shape. The mistake that ruins someone at $30,000 is completely different from the one that ruins someone at $2 million. If you walk into year 10 with the same instincts that protected you in year 1, you'll find yourself in a trap you didn't know existed because nobody warned you about the next one. I'm Tom. This channel is about real personal finance for normal people, the kind that actually works, instead of the kind that gets you to click on a thumbnail. No motivational fluff, no fantasy returns, just what the math actually does over time. If that's what you want, hit subscribe. Today I'm going to break down the dominant financial trap you'll face at 4 different net worth levels, in the order you'll meet them, with the actual math on how each one breaks you. Stick around until the last one, because the trap at the highest net worth level is the one I had to learn the hard way myself, and it's the one almost nobody warns you about. The first level, 0 to 100,000, the velocity trap. When your net worth is under $100,000, the dominant trap is anything that slows down your accumulation velocity. At this level, you don't have enough capital yet for compound returns to be doing much of the work for you. The wealth building at this stage is almost entirely about how much you put in and how consistently. Anything that interrupts that contribution flow, even by a few years, costs you wildly disproportionate amounts of future money. Marcus at 26 walked straight into this. He told himself he'd start contributing to his 401k as soon as the credit cards were paid off. Then, as soon as he got the next raise. Then, as soon as he moved into a real apartment. 4 full years of skipped contributions. 4 years where every dollar he didn't invest would have been the most valuable dollars he'd ever invest in his life, because they had the most time left to compound. Let me show you what those 4 years actually cost him. Imagine 2 versions of Marcus, both saving $300 a month, both earning a 7% real return. Version A starts at 25 and contributes every month until 65. Version B starts at 35 and contributes every month until 65. The contribution rate and the return are identical. The only thing different is the 10-year head start. Version A ends up with about $719,000 at 65. Version B ends up with about $340,000. The 10-year delay costs almost $380,000 of future wealth. Identical contributions, identical returns. The only difference is when the compounding clock got switched on. This is the brutal arithmetic of the velocity trap. Every dollar you invest at 25 is worth roughly twice as much by 65 as the same dollar invested at 35, because the earlier dollar gets 10 extra years of doubling. Skip a year in your 20s, and you don't just lose that year's contribution. You lose the multiplier on that contribution for the rest of your life. The other versions of this trap at this level are all variations on the same theme. High interest debt is the velocity trap dressed up as a normal household expense. Because every dollar going to 21% credit card interest is a dollar not going into a portfolio earning 7%. The arithmetic gap is enormous. Chasing get rich quick on Robinhood is the velocity trap, pretending to be the opposite. Because the time you spend trying to multiply small money by being clever is time you didn't spend just steadily contributing, which would have multiplied small money on its own through nothing more than persistence. What kills you at this first level isn't having a bad investment strategy. It's not having a strategy at all while time passes. If you take nothing else from this level, take this. Every additional year you wait to start is a multiplier you can't ever get back, and no amount of clever investing later closes that gap. The second level, 100,000 to $500,000, the concentration trap. Once your portfolio crosses $100,000, the dominant trap changes. You now have enough money that one bad bet can do real damage. The trap that defines this level is concentration, which means putting too much of your net worth into a single asset, a single employer, or a single idea. The reason concentration becomes dangerous specifically at this level is psychological. When you had $20,000 saved, putting $5,000 into your company's stock felt like a small bet. When you have $300,000 saved, putting $150,000 into the same company's stock still feels like the same kind of bet because the percentage hasn't really changed. But the absolute dollar exposure means a single bad year can now erase 3 or 4 years of contributions. The bet didn't change, the blast radius did. This is what got Marcus the second time. By 41, he'd been at his employer for 14 years, accumulating restricted stock units every quarter, never selling any of them. The company was doing well, the stock was up. By the time the position represented about $310,000 of his $480,000 portfolio, he wasn't thinking of it as a concentrated bet. He was thinking of it as his retirement. Then his company missed earnings 2 quarters in a row, and the stock dropped 58% over the next 4 months. His $310,000 position became roughly $130,000. He'd lost almost $180,000 in less than half a year on a single position he'd never actually decided to buy because the stock arrived in his account quarter by quarter and he just left it there. Marcus's portfolio dropped 37% from a single event affecting a single asset. Compare that to a diversified $310,000 position spread across the broad market. If the entire market drops 30% in a real bear, the same $310,000 becomes $217,000. That's a $93,000 loss, which is painful but recoverable in normal compounding time. Marcus lost about double what a diversified investor would have lost in the same kind of event, because he was holding one company instead of 500. The drawdown wasn't really larger, his exposure to it was. Most portfolio managers suggest no single position exceed 5 to 10% of total invested assets. Beyond that, you've stopped being an investor and started being a bettor on one company's fortunes. The math at this level doesn't reward bettors. The whole point is that compounding only works if your portfolio survives the next decade intact. A 60% loss on a 60% concentration sets your timeline back by half a decade or more. This trap shows up in lots of forms beyond company stock. People at this level put their entire net worth into a single rental property and call it diversification because real estate is supposedly a different asset class. They drop their full retirement into one mutual fund managed by their college roommate's brother-in-law. They go all in on a single cryptocurrency because the chart looks like it can only go up. What you bought doesn't matter much. The concentration is what kills you. The fix is administrative and unexciting. Once a single position crosses 10% of your invested assets, you sell down to 10% and pay the capital gains tax. That tax bill is real, but it's a small fraction of what concentration risk actually costs when it goes the wrong way. The hardest part of the fix isn't the math, it's the psychology. Because the position that got you to this net worth feels like the one that should keep going. Sometimes it does. Often it doesn't. The job at this level is to stop betting on which of those two outcomes is going to happen next. The third level, $500,000 to $2 million, the phantom wealth trap. When your net worth crosses $500,000, the dominant trap shifts again. You now have real money, but a particular kind of real money. The trap at this level is phantom wealth, which means looking rich on paper while having almost no actual flexibility with the money. Here's the data that frames it. According to the most recent Federal Reserve Survey of Consumer Finances, the average American millionaire household with net worth between $1 million and $3 million has roughly $450,000 in retirement accounts and roughly $503,000 of home equity. That's nearly $1 million tied up in two specific buckets, and only one of them is even close to liquid. The retirement money sits behind age 59 and a half, plus significant penalties. The home equity exists, but you can only get to it by selling the house, taking a HELOC, or refinancing, all of which are slow and expensive. Net it out, and you get something uncomfortable. For most $1 to $3 million households, roughly 60% of total wealth is tied up in home equity or retirement accounts, both of which are slow and expensive to access. When most people picture being a millionaire, they picture freedom and optionality. The actual experience for most millionaire households is closer to being trapped inside a structure that looks impressive from the outside. Jim is my friend who hit this level 2 years ago. He's a 52-year-old mechanical engineer in Ohio. His net worth is about $1.1 million, almost all of it built through 28 years of disciplined 401k contributions and a paid-off house. Here's how it actually breaks down. He has $600,000 of home equity, $440,000 in his 401k, about $20,000 in a brokerage account, and $40,000 in his savings account. On paper, $1.1 million. In reality, only $60,000 of that is liquid and penalty-free. That's 5.5% of his net worth. The other 94.5% is locked behind either his house or his retirement age. If a real estate opportunity came up tomorrow that needed $200,000 cash in 30 days, Jim couldn't do it. He'd have to sell investments inside his 401k and trigger a 10% early withdrawal penalty on top of ordinary income tax, which would mean pulling roughly $290,000 to net $200,000 after taxes and the penalty. The transaction cost is about $90,000 to access wealth that he technically already owns. Alternatively, he could take a HELOC against the house, which costs setup fees and locks him into variable interest payments for years. Either path makes the opportunity meaningfully worse than it would be for someone holding $200,000 in a taxable brokerage. The wealth is real, but the optionality isn't. The phantom wealth trap is what happens to people who arrive at this level without realizing the wealth they built isn't actually usable. They feel rich, so they start spending like they're rich, which is the other half of this trap. Lifestyle inflation they successfully resisted at lower net worth levels suddenly accelerates here, because the number on the spreadsheet says they can afford things. Spending creeps up across small categories. A nicer car one year, longer vacations the next, then the kitchen renovation that was always someday, then the country club that everyone at work belongs to. None of that spending comes from the illiquid wealth that built up to $1 million. all of it comes from current income, which means current savings goes down, which means the wealth building velocity that got Jim here quietly stops. The fix at this level is both structural and behavioral. The structural part is building actual liquidity outside retirement accounts. A taxable brokerage of $100,000 to $300,000 changes everything about what your $1 million can actually do for you. The behavioral part is recognizing that the millionaire feeling is not the same as the millionaire reality, and not letting the feeling drag your spending up to match the headline number. Almost every cautionary tale I've heard at this level is about that exact mismatch. The fourth level, 2 million and above, the time trap. This is the level I had to learn personally, and I want to be honest about it because it's the trap I almost fell into myself. When your net worth crosses about $2 million invested, something strange happens to the math. Your portfolio begins outproducing your salary. At a conservative 5% real return, $2 million earns $100,000 a year passively, which is more than the median American household income for 2024 of $83,730, as published by the Census Bureau. The compound math has crossed over. Your money is now doing more for your wealth growth than your job is. The trap at this level is not noticing that, or noticing and continuing to optimize as if it hadn't happened. The work pattern that built the wealth, the long hours, the missed weekends, the constant push for the next promotion, becomes psychologically permanent in a way that no longer matches the underlying math. You keep working at full intensity for an income stream that is now relatively small compared to what your existing wealth is already generating on its own. When I hit my own number a few years ago, I thought I'd stop. The math was clear. The portfolio was generating enough to cover my expenses indefinitely. I had run the calculation 20 different ways, and they all said the same thing. I'd built what I'd set out to build. I didn't stop. I said 1 more year. Then I said 1 more year again. 2 years where I worked 55-hour weeks for income I didn't really need, where the marginal extra savings made almost no difference to my long-term trajectory, where my portfolio earned more in passive returns than my labor was contributing in net savings. I told myself it was about the work being meaningful, which was partly true, but mostly I just didn't know how to stop. The identity of being a high earner had become who I was, and stopping felt like losing that identity, even though the financial reason for it was gone. What finally broke the cycle was sitting down with my friend Paul, who is the retired neighbor I've talked about before on this channel. Paul asked me on a Saturday afternoon what specifically I would do differently the day after I stopped working. I didn't have a good answer. I had built so much of my life around the work that I'd never really mapped out the alternative. He told me, in his quiet way, that the question I should have been answering wasn't whether I could afford to stop. It was whether I had figured out what I was stopping to do. That conversation took maybe 10 minutes. It moved my actual retirement date forward by 18 months. The math that finally got me to actually stop is the one I want you to remember at this level. If your portfolio earns $100,000 a year passively, and your job nets you another $150,000 a year after taxes and savings, then working that year buys you $150,000 of additional money. But that $150,000 doesn't change anything meaningful about your trajectory, because at 5%, your existing $2 million base will earn another $100,000 next year on its own anyway, and the $150,000 you added on top barely bends the compounding curve. What you actually traded for that extra $150,000 was a calendar year of your life, one of probably 20 or 25 working energy years you had left. That trade looks fine on a spreadsheet. It looks insane in retrospect. The trap at this level is that the math no longer rewards trading time for money, but your habits and identity haven't updated to match what the math is now telling you. The fix is to just do the calculation honestly. At what point does an additional hour of your labor become worth less than an hour of your remaining life? For most people at this level, that point arrived a few years before they noticed. The work isn't bad. It might even be good. But the financial reason for it is gone. And the only honest reason to keep doing it is because you actually want to, which is a very different thing from doing it because you have to. Here's the thread connecting all 4 levels. The trap evolves with you. Marcus's mistake at 26 was velocity. By 41, it was concentration. If he'd avoided both and made it to $1.5 million net worth, his next trap would have been phantom wealth. If he'd structured around that and crossed $2 million invested, his last trap would have been time. Each trap is invisible from the level below it, which is why the lesson from one stage doesn't transfer to the next. The mistake almost everybody makes is generalizing the lessons that got them to their current level as if those lessons will protect them at the next one. They don't. The habits that build your first $100,000 don't protect your first million. And the habits that protect your first million don't help you actually use it. If you remember one thing from this video, make it this. The traps you avoid today aren't permanent. They evolve as your net worth grows. Stay watchful at every level, and don't assume the next million is going to be safer just because the last one was. If you want to know what comes next on the channel, I'm going to walk through the specific financial decisions in your 50s that determine whether you actually retire when you plan to, or whether you have to push it back by 5 years. Hit subscribe so you don't miss it. I'll see you in the next one.